Hey y'all, welcome back to the channel. If you are in a position, it's 2024, and you need to buy a house and you're going, okay, this is not the best climate to purchase a home in, and I would 100% agree with you. I know most realtors like, oh, always buy a house. It's always a good time to buy a house. Well, not so much, depending on your situation. But I do know there's situations out there where whether it's a job relocation, maybe unfortunately a divorce, death of family, all kinds of life issues could come up where it puts you in a position where you need to purchase a home. So I'm going to give you the three ways to purchase a home that are going to basically give you some options. So some of them might not work for you, but just want to kind of give you some option. And as I see it, there really are only three ways to buy a house in 2024. So let's get into it. Okay, so the first way to buy a house is just to buy a house like you normally would, right? So just you go speak with the lender. They're going to get all your financial information, and then they're going to come up with a decision on what home you qualify for, what the interest rate is, all that good stuff. So what I'm sharing right now is what today's, as of the recording of this video, so this video is not going to age well, I hope. But this is what the rate is. So you can see the 30-year fixed is 7.5%. This is based on Mortgage News Daily. This is how you know the market is completely out of whack. If you notice, this is an ARM. This is an adjustable rate mortgage, meaning it's only going to be fixed for the first 7 years, and then it's going to adjust, right? And so the ARM, which is more risk for a buyer taking that out, right? So ARMs typically are designed to be lower than the conventional rate because it allows more folks to qualify for more and to get a little bit lower payment. But do you see this? It's 7.55% for the ARM. That's completely out of whack. Why would anybody go for an ARM where you can get a 30-year fix for a lower rate? It doesn't make any sense. Things are happening so fast, it's so dynamic that I think the market is just having a hard time making the adjustments, right? So that's your option. You can go speak with the lender. As of the recording of this video, these are the rates that you're looking at. So 30-year fixed, 7.5, 15 years, 6.9, jumbo 6.67, an ARM 7.55, which is pretty much outside of the jumbo, the highest. FHA right now, 6.99, and 30-year fixed for a VA loan is 7%. So again, market's been very volatile. So by the time you see this video, probably going to be hopefully markedly different and hopefully down. Although a word on that is, guys, we're probably not going to see interest rate cuts. I think I have a video that's also not going to age well where I said something like, oh, we'll be closer to the fives because the summertime, because that's what everybody was saying. But inflation is being incredibly sticky and they're just not. Now the forecast is we're not going to see any rates this year. So what that means is you need to, if you do need to buy, you need to kind of wrap your mind around what are my options. And so again, this is one of them. You're just going to go meet with the lender. Price, and here's the other thing I would definitely recommend doing. Make sure that you're shopping around because it can, the rates will vary from lender to lender. So don't just go with the first one. Shop around, pick at least 3 different lenders, and then price compare and see what you're getting for your loan. And so you can go with a direct lender, and the direct lender, the way that's designed is that they are the ones making the loan. They're going to underwrite that loan in-house. So they're making all the decisions. Good thing about that is they have more control. Once you do get into a transaction, find a house that you like, they have a little bit more control over the pace. The other option is to go with a mortgage broker where what they're going to do is collect their information and then they're going to shop it out to see who's going to get you the best deal. Best news about that is that you're going to be able to have someone shop for you. So you can kind of see, they're going to kind of see where you can get the best deal. The disadvantage of that is they tend to have a little bit less control over like the underwriting process because they're sending it out, right? They're kind of playing the middleman, so to speak. So just know that's kind of how that works. But please, please, please make sure you're shopping around and making sure that you can get the best rate based on what we have to work with. We're in a what we have to work with kind of environment right now. And so definitely you want to do yourself a favor and just shop around because it could save you thousands of dollars. Okay, the next way that you can purchase a home in 2024 is to assume the loan. So all those folks back in 2020, 2021, a little bit, that are sitting on those lovely cushy 2.5%, 3% interest rates. Well, those folks, a lot of them are interested in selling, and you will find that a lot of those homes are also on the market. Sometimes it becomes a little difficult to find which homes have assumable loans. So just so you know, typically FHA and VA and USDA loans are assumable. I have another video where I talk a little bit about assumable loans, so I'll include the link to that video for this one if you want to go take a watch of that one. But assumable loans, essentially what you're doing is you're going to come in and let's say the seller, you're purchasing the home, seller has a 3% interest rate. So you're going to take over that loan, meaning that you're going to the seller will let their lender know, hey, I'm selling a house. I'd like an assumption packet. They're going to send that information. Essentially, you're going to qualify for the loan just like the seller originally had to do. So they're going to need some paperwork. You're going to need to financially qualify. And then once you're qualified, basically you'll just step into that position. So you will also get that 3% loan and continue making the payments. Now, one thing that a lot of folks don't talk about when it comes to assuming a loan is that you do have to pay the difference with the seller, right? So let's say the property is listed for $300,000 and the seller has $100,000 in equity. So you're going to have to, so your loan is going to be on $200,000. So let's say you have a 3% loan on $200,000, which is a great rate. But then now what happens to that other $100,000? Because the seller needs to be cashed out, right? They're not going to just give that money away or just walk away from it in that case. So you would either need to do cash or you would need to take out a second mortgage in order to pay the seller out their equity. For most folks, it's going to make the most sense if you have a cash. If you're selling another home and you're going to have some liquid cash that you can use to just pay that difference in cash, that's going to be your better fit. Because if you're going, some lenders will not allow you to assume a second mortgage, so that's something to know. The other thing is chances are great, you saw the interest rates, chances are great that second mortgage is going to be a little bit higher, so it might not wind up benefiting you as much. Like maybe you'll get 3% on your first, but if your second is 9%, then you're still kind of at a deficit in terms of overall interest rate. So something to know about that. The other thing I'm going to highly suggest you do if you go down this path, it is not for the faint of heart. Do me a favor and check out Reddit. Just Google Reddit assumable loans and you will see horror stories. A lot of times you see those horror stories because if you're trying to do that with just your realtor and or you or the sellers, doing the follow-up, because the thing is with an assumption, the lender is not going to make as much money on that loan. So average on FHA, they may be making, I don't know, $900. On VA, maybe it's closer to $300, something like that. Whereas on a new originated loan, they're going to make several $1,000s, right? So it's not to say that they don't want to service the loan, but from a return of investment kind of thing, they start to look at it as more of just an administrative process and not a new loan. Now they're not supposed to be doing that. And so you're going to notice that if you do a little research, just check out a few discussion forums about assuming loans. You will see that people are waiting literally months to get a loan officer assigned in some cases, or months, 6 months to close on one of those. So know that, again, it's not for the faint of heart. What I'm going to suggest and what I'm showing here, this is just an example. There's a number of companies that do this, but this is called AssumedLoans.com. And what they do is they help facilitate the loan assumption. If you go down this path, I recommend you use somebody that's going to actually facilitate the loan. So there's Assume Loans. There's another one called With Rome that will do it as well. These folks know how this works, because to be honest with you, until this current market, lenders haven't really had to do much work when it comes to assumable loans. And so even internally, that lending staff doesn't know how to do them. And or if they do know how to do them, they're so overwhelmed where they may have closer to like 1,500 folks trying to assume a loan, and they've got a department of 5. Right? So they're just not ready for the volume. And so you need somebody that's going to constantly be calling every single week, where are we at, trying to push that file forward. It's not one of those things where you can just be passive and give all the information to the lender and they're just going to do it. Not going to happen. It's definitely a process where you're going to have to, somebody's going to have to drive. And so what I recommend is definitely go with a company that will help do that. Like I said, this isn't just an example. I haven't worked with them before, so I can't give you all the details on them, but I will say that it is in your best interest to work with a company to help you navigate this, because it is very complicated, and it could be pretty lengthy if you don't have somebody that's really on top of it for the duration of the transaction. So just know it's available. If you have psychologically, if you can deal with a longer escrow, and the seller is open to that, then I say go for it, because that's the only way that you're going to get those 2.5%, 3% interest rate. So it's definitely worth it. In the long run, just know that it could be a little bit painful. On average, what I'm hearing is that somewhere between, if you have somebody that's working on this, that's helping you with the assumption, somewhere between, let's call it 60 to 90 days is pretty typical. So just know that as an option. Long run, great opportunity to get a very, very low interest rate if you have liquid cash to make up the difference with the seller. But you're gonna pay for that in time, because it's not an easy process. So assuming a loan, that would be a second option in terms of how to buy a home in 2024. Okay, so the third and final way that I'm recommending that you can buy a home in 2024 is just go with the builder. A lot of times the builder will have, as you can see by this example, this is Highland Homes. They have developments and homes literally all over DFW, really excellent builder. And so currently they are offering, if you see this, 20%, $20,000 to use how you choose. So you can use it to buy down your rate. You can use it to for your closing costs. And so you have a few options of how you can allocate these funds. A lot of folks are using it for a buy down because they're still hopeful that we'll see some price reductions, at least by the time we get to 2025. So this is what Highland is doing, which is a great option to help you get into to a new home. And this would be for their inventory homes, I believe, as well as sign a contract on a new build or an inventory home in DFW from April 25th to May 31st. And then you get this additional credit. So it's basically free money, and you can use it how you choose and what makes the most sense for you to purchase your home. Another builder in the area is Meritage Homes. They're offering the same thing. So you see here is $20,000 that they're giving in flex cash. And so you can use it towards closing costs. This is interesting. Price reduction. See, normally you don't see this. This is letting you know we're not in the market where like send us your best and highest offer and how much over do you want to bet. We're not in that market, because the reason why I'm saying that they're saying that you can use this $20,000 as price reduction is a big deal for a builder, because typically they would prefer to give you 20,000 incentives, even 50,000 in incentive, if it means that the price stays the same. So let's say the house is $450,000 and they have 50,000 in incentives. They would prefer you to take it as an incentive versus, hey, take it off the price and bring it down to 400,000. Why? Because if you purchase your home for 400,000, you close on that home, what's the next buyer that purchases that same model going to want to do when they see that home sold for 400,000, right? They're going to want 400,000. So it creates a lower demand, or not a lower demand, it creates a downward demand on pricing for the builder. So they don't want to do that. They would prefer to give you $50,000 in closing costs, and you can use it how you want, or in this case, 20,000. But let's keep the price the same. So that way they can keep the prices stable. And they're not, for every release or every phase of their development, they're not actually winding up going down on the price. Typically and historically, for every new phase, the developer, it starts to go up on the price. So phase one is probably going to be your cheapest ability to get in. I have another reel where I talk about buy the dirt. That is when there's nothing there, all you see is little green poles sticking out of the ground, and it's just plots and land, and there's not even a frame up. That is the cheapest way to buy a new build, is when it's just dirt and you have to use your imagination. The next cheapest phase is to buy in phase one. Because like I said, typically in the normal circumstances, the prices tend to go up as they get into later phases. Now, you're probably thinking, well, wait a minute, for DFW, we're in a situation where we're actually having more inventory, which is needed, right? Overall, nationally, we have a housing shortage. In DFW, we're starting to see where we're getting closer to 4 to 6 months worth of inventory. So, well, right now it's probably 4 months. And at 4 months, it's really kind of feeling a little bit more balanced. Property, especially resale, is sitting on the market longer, which means that you have more ability to negotiate. So that is a good thing. But what I'm also noticing is when the market was hot, it was taking, for a developer, they would say, in terms of how long it takes to build a home, somewhere as short as 4, or let's call it 6 months. I did hear 4 once, but let's call it 6 months to 9 months. That was typical. Now, today, going to talk with the developers, they're saying a year. I'm like, that's a significant difference between 6 months and now all of a sudden it's a year. What's going on? Is the labor, or do we not have the labor? Like, what's going on? They're not building as fast as they were. And that, I believe, is intentional. Why? Because they want to keep the prices going upwards, right? And so if they release a bunch of homes, bunch of inventory into the market, and we have the interest rates of what we're seeing, where people are kind of waiting, then that inventory is going to sit. And what's going to happen? They're going to have to reduce those prices. So I believe they are intentionally holding back inventory so that they don't have to go down on the prices. There's a new development, for example, just behind, if you're familiar with where Prosper, Texas is, I did a video on that too. That's where I live. There's a very well-known development here called Windsong Ranch. It has a lagoon and all that good stuff. Amazing community. Well, that same developer is building another master plan, massive community right behind Windsong Ranch. Those properties are starting at high 8s. That's the base price. And so in visiting those models, they're saying that it's going to take a year to build those homes. And like I said before, we're talking closer to 6 to 9 months. So they are slowing down for some reason. Like I said, I just suspect it's so that they can keep those prices going upward. But even the homes where they just opened these models, they're saying they only have 3 left. 3, and these models just opened. This is because they're not releasing the lots, right? Could they? Again, I don't have the inside track on this, but I suspect they could. But I think it's intentional around trying to ensure that those prices don't start dropping down, right? It's a business. They're trying to make money. I get that. And so just be aware of that. I do think the other thing too is, I don't think I pulled it up here, but on a lot of times, going back to the builder, if you work directly with the lender's builder, a lot of times you do the in-house financing, they can offer you better rates internally. So I just saw one, I can't find it, but where it was 4.5 or something like that, 4.7% fixed interest rate if you went with their lender. So you can be on the lookout for that kind of stuff. So there's a way to do it. You can still get a more reasonable interest rate, but your best way to do it, to be honest, is to go with the developer's lender and see what they can offer you. Because a lot of times there's incentives. The other benefit of doing it that way is that if by chance there's any hiccups at all with the loan, something takes longer than normal, that kind of thing, if it's their internal in-house lender, they're more inclined to work with you. But if you pick somebody out, outside, and you went on your own and got a lender, they tend to be less inclined to work with you. So that's another benefit by going with the developer's lender. Well, another word about the buy down, we were talking about that a lot because we're anticipating that this year the interest rates would go down. So there's a lot of folks that do have a lower interest rate, but that interest rate is about to adjust because they were anticipating that the interest rates were going to go down so they can refinance, and that has not happened. And so right now, I'm going to suggest not to do a buy down. And again, unless you're in a situation where you really just absolutely have to buy something, and going directly to the builder is not an option for you, assuming the loan is not an option for you, and you're like, I got to do something. This is my next best step. I'm going to buy down the rate. Great, but just keep an eye on that, because again, those buy downs, especially depending on what type of buy down you do, there's going to come a time where that's going to adjust. So what I would suggest you do is whatever the ultimate rate is going to be. So let's say it's a 2-1 buy down, so it's going to adjust to its ultimate rate in a year, or I think it's 2, yeah, I think in a year, then make sure that you're going to be really comfortable with what the ultimate rate. So if it's actually going to wind up, maybe you start at 5%, is actually going to be 7, that you can financially feel comfortable with 7, just in the event that you're not able to refinance the home for any reason. We're in a very crazy economic climate. And so you don't want to just assume you can refinance, right? So you just want to make sure that you're not putting yourself in a challenging situation, because the other thing that we're seeing is, we're starting to see upticks in foreclosures and REOs and things like that. And so I went through the 2008, economic crash, and each crash is different. So it's not like it's going to be the exact same. And I'm not saying it's going to crash. And I'm tempted not, maybe I shouldn't say that word, but what I am saying though is, a lot of times folks assume they can refi, but remember now, in order to refi, you need to have equity in the home. So if we start to see some prices softening as more inventory enters the market, and we see more inventory generally means there's more competition, which means folks are kind of in situations where if they haven't got an offer on the home, they're going to reduce that price of that home. So that's going to bring the overall price down, which in some areas it's absolutely what we need. But just know that 1, you have to have equity in your home. 2, you have to have a job. We're seeing a lot of job loss. And I don't mean to be a Debbie Downer. I just want to be a realist around what's happening in this market. So you got to have a job. And so if anything happens with a layoff or anything like that, then you're not able to refinance. So just a couple things just to be mindful of. There's never harm in waiting for the right time to purchase a home. Like I said at the beginning, most realtors are like, buy a home, it's always a great time to buy a home. It's just a bad time to sell one. Not so much. So depending on your situation, just make sure that you look very thoroughly at your financials and try to forecast out a bit. Because you don't want to be, the house should be a blessing, not a curse to you. And so you want to make sure that you've taken the time to really count, give yourself some margin. If something does happen, do you have wiggle room in your budget where you're able to absorb that? One final thing that I'll mention that I think a lot of folks don't plan for, and we're seeing, I'm seeing more YouTube videos and stuff like that about this, is know that even if you get a 30-year fixed loan, your payment is going to change because of what? Taxes and insurance. Both of those things have gone up over the last year. And in some cases, we're hearing we're hearing where different insurance companies are pulling out of certain states and not writing any more policies in those states. If your neighbor has a claim on their house, maybe here in Texas, it's mostly going to be hail damage. So if they have a claim and you see a bunch of new roofs coming on, anticipate that there's a chance that your interest rate's going to go up. And so and with taxes here in Texas, the one thing about, we don't have income tax, we do have property taxes. They tend to be a little higher. And so just know that those are things that, although your mortgage is going to be fixed, your taxes and your insurance, that's going to be variable. So depending on what's going on, that could go up. So especially if you're a first time buyer and you weren't aware of that, you thought, once I purchase a home, this is what the payment's going to be forever. Not so. So just know, and there's no way to tell exactly how much it can go up. In some cases, folks are reporting their payment went up as much as $500 to $1,000. So just, these are things that you want to just make sure that you're talking with your lender professional and talking with your realtor about, okay, what is the full cost of owning this home? The way I'm talking about it makes it sound like it's not a great thing. It may not be. For certain folks, it's just homeownership is a wonderful thing. It comes with a lot of responsibility. And so I think we talk about the fun part of it, the tax advantages, the wealth building, for sure. All of that is true. However, there's also the darker side of it, the more challenging side that I think folks underestimate sometimes, and then they get themselves into difficult situations, which could be painful. So you just want to make sure that you're working with somebody that's really going to take the time to educate you on what the full cost is of home ownership, so that you can go into it informed and making the right decision. And so with all that said, again, those to me are the 3 options. So go ahead and shop around for a rate, use a mortgage broker or go to direct lender, but definitely shop around for the rate. If you're going to go ahead and go down the path of assuming a loan, it is an excellent opportunity to lock in a very, very low rate. No doubt. But I would say get some help with that because it is a very complicated process, and it's a process that must be driven. Somebody has to be pushing that thing forward. Otherwise, you could very easily be sitting at 6 months and still not being closing. So that's not the experience that you want to have. And then, like I said, third option, work with the builder. Go with the builder, giving a lot of incentives. Like I said, 20,000 right now. And the market was hot. They were talking about, best and highest, you had to just make an offer and it had to be X amount over for them to even consider it. Clearly, we're not in that market anymore. And so you're able to really negotiate some, even to the point of the price, which is a huge deal. So definitely there are some deals to be had if you're in a situation where you absolutely need to buy a house in 2024. If you're not in a position where you need to buy a house, you want to, but you don't need to buy a house in 2024, just wait. I do anticipate that we're going to see so next year's a little bit of softening in rates. I think we're going to see more inventory, which is going to allow you to negotiate a bit more. And so it's just going to overall put you in a better position. While you're waiting, though, don't just wait passively. I'm going to recommend that you wait actively. What does that mean? I mean, get yourself in the best possible position to purchase a home. So that way, when that opportunity hits where that interest rate is great and you get the ability to negotiate and maybe prices have softened, that kind of thing, that you're really financially solid. So the way that you do that is one, if you're working on, building your down payment, go ahead and be stocking money away for that. Two, I would say make sure your credit is good. So even if you have good credit, let's say you're already in the sevens, I would still recommend maybe working with a credit repair consultant just to get it even higher. So you're getting in the 7.5, 8. So that way, when it's time for you to purchase, you can get the absolute best possible rate that is available. So those are, like I said, saving the cash. Make sure your credit is in tip-top shape, pay down that debt. So your debt to income ratio when it's time to qualify for the loan is in good shape. And the other thing I would do that they really hesitate to do this, but I'm going to implore you, even if you know that you're not going to buy anything until next year, I'm going to suggest you still start kind of shopping around for lenders and creating relationship with a lender, because they can tell you specifically based on your specific financials and where you're at, what do you need to do to be in good financial position. So they can look, because your mortgage credit score versus your general consumer credit score are two different things. So you're going to want to know what that is. And then they'll be able to paint a picture for you and develop a plan for, okay, we're going to purchase a house next year. Then here's what we need to do. We need to pay off this debt. We need to get this credit score up to this. We need to adjust, whatever it might be financially. They can tell you specifically what to do. A lot of folks, they don't want to, because that's when things become real and you got to dig into your finances. But I'm telling you, if you do that early, that gives you plenty of time to work out whatever you need to work out, so that when you're ready to go shopping and ready to look for that home, you've got all your ducks in a row. So that way you're in the best possible position to get a great rate, to, be able to really negotiate because you're a strong buyer, really be able to negotiate well for your property, and ultimately get not only the home that you love, but the mortgage that's going to work for you, that makes sense for your family and makes sense for you financially. So those are just some tips. Hopefully this has been helpful to you. If there's any other information that I can provide around just kind of how to navigate this market, it's a crazy market. We're seeing some really interesting things. Just on all fronts of real estate. So it's a very fun and interesting time to be in real estate. So if there's anything that I can do around your specific situation, obviously my goal is just to provide folks with information so you can make informed decision. And in the event that you decide that you'd like to move forward, I would be honored to be able to assist you. So please feel free to leave a comment, reach out to me if there's anything that I can do. And let me know if there's, based on anything that I've shared, what are you seeing in the market? For, everybody's watching from different areas. Are you seeing something different? And maybe your market is really tight and you don't have quite the same amount of inventory, so you are in a multiple offer situation. Just be curious on what you're seeing. Here in Texas, we're definitely seeing more inventory, which is what we need. which also means that we're seeing a little bit more softening in prices, and properties are sitting on the market a little bit longer. So again, that's great for buyers because it allows you to have a little bit more negotiating power. So anyway, I think that does it for this video. I've talked much too long. Again, if I can do anything to help you, please reach out. That's what I'm here for, surfacing the DFW area. Would love to give you some additional information. So that way you can just make an informed decision for what's next for you, whether you're buying in 2024, 2025, or 2035. Here to help you. All right, that's it. Video's too long. I'll see you in the next video.